Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to rip through Twitter, see what people are sharing on social media like we normally do. I posted some stuff up myself as well, just to have some more content because I didn't really like a lot of the content that was being shared was kind of boring. So I put some stuff up myself. But we'll fly through it, generally related to three different areas: wealth building, commodities, and or financial topics. Those are the ones I like to cover. So let's go in there and see what people are sharing. If you want to follow me at @finding_finance, and if you want to join our community, finding-value.com, you want to learn a little bit more about investing, you want to learn how my approach and strategies are to play this commodity bull market, that's a great resource to be looking at. We still have a discount coupon code, Mayday, MAYDAY, that is still active. Even though it's June, it is still active. And you've got 50% off the first month, only the first month is 50% off. Or you can join the yearly membership that has larger savings for an entire year. So we've got myself posting up some information. It says, are you seeing this? GDX and SILJ charting some ratios here, just feeling what is out there to invest in and what looks best. So SILJ versus silver itself, what we're looking for is a potential bottom here and a breakout of that downtrend line. When we break out of that downtrend line, what that means is that the junior silver companies are starting to outperform silver itself. When you get these big spikes like in 2016, where we bottomed and had a monster move, we saw a massive outperformance of the junior companies during that time frame. I participated in it. I wasn't in the junior companies, but I was in the producers in 2016, and it was one, two, three, four, five, six, seven, and I sold it a little bit. I sold it like 8 or 9 months in, I think. I didn't get the top. I wrote it back down a little bit and sold probably maybe it was 10 months or 11 months out. But I captured the bottom of this, and I wrote it all the way up to probably somewhere in here, and it was a big move. In fact, it changed my account value in my Roth IRA because that's where I was doing it quite substantially. I think I did like a 3 or 4x on the entire portfolio in less than a year. And I was like, man, that was insane. Um, this year in 2016, if you go back and you look at a lot of the charts, they all had falling wedges right to the tip. One company that you could look at if you're interested is AG during that time frame, because that's one of the companies that I played with. And there's a few other ones too. And you can see the setup, and we have similar setup today. So if you ride it from point 4 all the way back up to point, let's just call it 1 or something like that, you're getting a little bit over 2 times leverage to the price of silver. And when silver rips, it rips. If we get the big numbers that some of these guys think, and I think that we'll probably post a big number in silver, we could see silver junior companies do something absolutely ridiculous. Because from bottom to top, and I'm not saying that we're at the bottom of silver, but from bottom to top, silver can go 20 or 50x, somewhere in that range, 20x to 50x on the underlying commodity itself, silver. Then you've got SILJ, and if you're doing 2 or 2.5 times that, I mean, that is an absolute ridiculous return. That is possible. So that definitely is on my radar here. We've got GDX versus gold. That is still grinding out a bottom here. In stage analysis, this would be in the first stage. We're still grinding out a base, and we haven't broken out of this base yet. The ideal buy point for a lot of technical analysis people are when we break out of this base and go right into stage 2, like right at the beginning of stage 2, because that's generally when the move occurs. So we're still in stage 1, and we're still very early in this move for gold and silver mining companies. And then we've got SILJ versus GDX. I just said, you know what? Let's chart the two against each other. Why not? Because we can. We can do whatever we want. And what I see here is SILJ actually looks favorable and looks like it's going to outperform GDX. That looks absolutely ridiculous. I hope that occurs because I am positioned in companies that are included in SILJ. And hopefully that's a big outperformance. And that could be bottom to top, it could almost be a 2x outperformance. So the juniors could 2x GDX in terms of returns. Unleash the beast. Yeah, talking about the beast. That's what I'm talking about. It says oil equities sure look juicy for an outperformance here. Let's dive into how to play this during the question and answer session this weekend that we have at 5 p.m. today, Mountain Time. So XOP divided by crude oil, we're getting a little bit jiggy with it. We've been consolidating sideways since 2022, and it looks like we're ready to break out of that consolidation here any second, or maybe we're kind of on the cusp of that breakout for XOP to outperform crude oil. Generally, XOP outperforms crude oil when crude oil prices go up, not down. We've got OIH, which is the energy service ETF. We had a monster sell-off move. We've been buying it. We've been buying energy service companies in the on the website here at this really low valuation. I've been cherry picking what I think are the best. We've nabbed them at the bottom there. As long as you're a kind of a longer term time frame approach, there's still a lot of really good meat left on the bone in terms of opportunities that are out there. And this also looks like it's wanting to try to put something together here and maybe get an outperformance move. And then I chose PSCE, which is another ETF. It's got more of the small cap companies. This thing also looks really good. You can see we had a big outperformance all the way into about 2014, 2015. Huge underperformance, just a massive shellacking to the bottom, just absolutely getting murdered to the bottom here. We had a nice good basing period that I've got showing the arrow going sideways. And I think what's coming is an upward move very, very soon. So that also looks really good where PSCE, which is the small companies, could outperform crude oil. Coming down on uranium equities about to outperform question mark. Now, we've got a couple of up. We've got SILJ looking pretty good. We've got some of these oil equities looking good. And uranium here, are we going into a commodity bull market? Sure feels like it. So we've got URA divided by UX1. And we've got that downtrend line that just, and I know some people are kind of bearish on uranium, but this isn't the time to be bearish. This is the time to load the boat before the boat leaves the dock. That's what I'll say there. Patience is what's going to make you money. And knowing that these charts are starting to break some of their downtrends here, I would be in bull mode, guys. I would be in bull mode. Then we've got URANIUM as well, and that is broken out against the uranium futures pricing as well to the upside. Again, we've got URA and URANIUM both showing us that we could be entering a new up leg for uranium equities. Would I be bullish? Yes. Come on, guys. Yes, I would be bullish, and yes, I am bullish, and yes, I'm still holding my uranium equities for hopefully a very big move. I will be extremely happy if we continue to move higher, even at the rates that we're going. I would still be good for a lot of the companies where the rates just kind of grind on up and just keep going, going, going. And I'd love to see outperformance for many years. Love it. But this looks pretty good, and it could have a big move. We've got gold to oil ratio is cheap. Anything over a ratio of 30 is cheap. 30.5 is the current ratio. We also can see that natural gas is still cheap to oil as well. So this is gold to oil ratio. We use this ratio to determine if crude oil is cheap against gold. And now keep in mind, gold is cheap against all of the financial assets. It's cheap against the S&P 500. It's cheap against the NASDAQ. It's cheap against all of these financial assets, bonds. And bonds they've gotten They've come down quite a bit, I'll say that. But crude oil is at a 30.5 ratio. It's where that blue line is going across. If you buy where the blue line is or anywhere above it, you are literally buying the bottom of the market when you compare it to crude oil. This is a way to objectively say that crude oil is incredibly cheap on an inflation adjusted basis. And I don't use inflation like the CPI or DXY, like that's all garbage. Just crinkle that up, throw it in the garbage. Do it against something like gold because gold is a better measuring stick that is more reliable. We don't know what the value of the DXY or the dollar really is. They try to manipulate those numbers. Gold, they can't really manipulate. And this relationship between gold and crude oil has remained stable between about 6. So 1 barrel can buy 6 barrels of oil all the way up to about 30. You start to get above 30, you're hitting anomaly periods in history where it doesn't really stay there for very long. Like we had this monster move in 2020 when they shut down the economy. Then I bought a bunch of oil and really changed my life and turned it around. This is something that you can use to identify those bottoms, is what I'll say there. And then we've got crude oil versus nat gas. Almost like this is a double top here in a potential capitulation bottom of maybe the end of cheap natural gas being that cheap. We're at a ratio of 29.76. We got up to 51 just recently. And I'm sure you guys on the website, I was buying some of those natural gas companies down there, and we got some really good prices. And patience is required. But, and they're up. I mean, don't get me wrong, they're up. You don't need patience, but patience is what got me to buy at that cheap level here. Go look at the 90s and 2000s of natural gas. You can see how low we were. We got to a low of 2.79. Could you imagine if we go from 51 down to like 3 or 50 down to 2? What that means, if we go 50 to 2, that means that natural gas had outperformed crude oil by 25x. 25x. If we were to go from 51 like we did up there all the way down to, so just say 50 to 2. So maybe it's around a 20x. Okay, fine. But that's ridiculous, guys. Do you know what the returns would be for some of these companies if we see that type of move again? It's unbelievable. Unbelievable. So we've got unusual whales here. Unusual whales. That's an unusual name. 5 years ago, renters needed to make less than $60,000 a year to afford the typical rent. Now they need to make almost $80,000 per fortune. I thought buying a house was bad, and this is here telling me that the typical rent, that you need to increase your income by $20,000 over a 5-year period. I bought a house, it was longer than 5 years ago, but I don't have to do crap. My income doesn't have to go up to maintain this house because I have a locked-in mortgage. That's why I did it. And if you can foresee and the financial markets and you've got some degree of looking at when something's cheap, houses were really cheap from an affordability standpoint for 2011 all the way up to I'd say 2021. Incredibly cheap. It was a great time to enter the market, lock in those low mortgage rates, and have a really cheap mortgage payment for a long time. But if you're renting, it looks like rent just continues to go up, unfortunately. Coming down to Game of Trades, and I wanted to make a comment here. He says Bitcoin's about to make a big move. You don't want to miss this, is what he's got on this particular post. I've got underneath this a few posts below this one. He made another comment that contradicts Bitcoin going up. So I'm a little confused how you can play both sides of this coin, so to speak. Because he's saying Bitcoin's a big move. Now, Bitcoin moves up with greater and greater liquidity. And you know what else is looking like it wants to go up? All those really inflation-sensitive assets that I just went over at the beginning of this video. Oil is inflation sensitive, uranium, silver. Almost like we're going into some gigantic, highly inflationary cycle where all the inflation sensitive assets are going to go up and hard assets. So keep this in mind. He's got this. Bitcoin's about to move up big. And then we're going to hit back that a little bit behind that. So producer price index versus the consumer price index. I've got that ratio chart here that I want to touch on. What I say is it looks like a double bottom to me and potentially could head higher. Pair this with the broken 40-year downtrend in interest rates and things could get interesting. Rising interest rate environments move money differently in the system between asset classes. So this is the PPI to CPI ratio, and I want to explain this just a little bit. We had a very big move lower where the producer price index consistently underperformed the consumer price index. What does that mean? It means that we've got disinflation or very low inflation. Think of it that way. So declining inflation or very low inflation. And that occurred from the 1940s all the way to the bottom of about 2000, 2001. You can see in the 1970s, we had a big shift higher in the PPI outperforming the CPI, which indicates that we were in a very inflationary environment. So when the PPI outperforms CPI, it means that commodity prices are going up at a faster pace than the consumer price index. And then they held it all the way till the early 80s. And what I saw during this time frame for the market conditions, because this is what's important, the market conditions is what drives this ratio. And the market conditions was we hit peak oil in 1970 of conventional oil in America. And we had a lot of credit expansion through monetary bank loans from the baby boomers buying homes. That's what this created here. We went all the way down and we came into another housing market boom from about early 2000s all the way till later 2000s, 2007, 2008. And that's what drove the PPI to outperform the CPI during that time frame. Then we came back in a big consolidation, 3-hump consolidation back to about 2020 of that COVID low. We had created a lot of stimulus, and we were also just entering an expansionary phase of real estate, which introduces credit into the system. Another big impulse move higher. We hit a lot of resistance through here, going across both the trend line going down and the horizontal. We came on back. And now I'm looking for this to work its way on up. If we work our way on up and break out of this pattern to the upside, it means that we've entered a new era. And I can't tell you exactly what that era is, what's driving that era. My guess would be that we've got problems with our debt in the markets for the United States dollar. And that credit will continue to pump into the system. Money comes into the system at a faster pace than what commodities can keep up with, which then would put the PPI going up faster than the CPI for a good probably period of time, which would be highly inflationary. Another thing that validates my opinion here is interest rates. So you can see a rising interest rate environment in the 70s all the way up to 81. It peaked in 81, went all the way down to the bottom of 2020. We have an inverted head and shoulders bottoming pattern, and we've broken out of that 40-year decline in interest rates. And in my opinion, we are at a new shift to an increasing interest rate environment, which then also coincides with this going up, where the PPI ratio to CPI ratio is going to go higher, which means that we're in an inflationary environment. So I stack on all of these pieces of evidence to see where we could potentially be going. And under that type of environment and market conditions, you're going to see oil and gold and silver work its way on up. And they're putting in really good chart patterns and breaking into new all-time highs, gold is, and silver is just lagging behind it. I think this is all playing out under market conditions that were similar to a rising interest rate environment, which we're seeing, which is similar to an increasing PPI to CPI ratio, like we saw in the 70s and also the 2000s. And I think we're going to see another wave here coming up. Coming on back. I've got more data here. So total residential construction spending, construction employees, and total construction spending. Here's the data. So this is total construction spending on residential. It's up there and it's kind of hanging out. Now, if this rolls over and heads lower, that's generally when we see a slowdown in the market. But that doesn't look it doesn't look like all employees construction is rolling over. That's continuing to move on up and looks very strong. Very strong there. And then we also have total construction spending in the United States. And that does not look like it's ready to turn over. You can see that this turned over in 2006 and definitely rolled over again in 2007-8. And that was your big crisis. That also had a crisis in all employees construction, because if you go back, that rolled over in 06-07. 05, 06, 07, it was rolling over. So 05, it went sideways. 06, it rolled over. In 07, it was really moving lower. That also occurred in the other recession and a real estate bust in 1990, 1991. So that easily seen in all of these charts. Here's 06 rolling over in total construction spending. So we're not seeing that yet. I'm not stating that this can't go lower. We're just not seeing it yet. So I don't think the recession people are going to be right, at least from the construction side of it, the housing side. Most recessions come from the real estate cycle busting. Most of them. Not all of them, but most of them. Contracting an offshore drilling rig. So this is what he is potentially saying for profits. 2024, 25, 26, and then all the way to 2032. You can't even walk because it's so much money. I would say that's going to be the case for commodities in general, and that's what our portfolios should look like. And that's going to be the cycle. Expansionary phase of real estate. It's going to be a shortage or a deficits being worked through the system on the commodity side. And the profits and money is going to rotate into our sectors, leaving us with bags of money. Fingers crossed. RevCap says going below 4 this year, and Logan says third calendar year of the lowest home sales ever once adjusted to the workforce. So we've got really low home sales, and that's dealing with the affordability. The inventory levels are not that high, so we're not in a bubble. But existing home sales are way down, and a lot of inventory is not moving. Well, I wouldn't say inventory is moving. There just isn't a lot of sales, and there isn't a lot of homes for sale. Put it that way. Here's back to Game of Trades. Remember, I was talking about Bitcoin and that big move that he was talking about earlier. That's what he was saying. Housing is leading a recession, and it's now pointing to a second half 2024 economic downturn. Is this time different? And he's got a thread here of existing home sales that are way down there. And he basically, I don't like using home sales as a weakness indicator because on existing homes, because we have no homes to really sell. So how do you have high sales if your inventory is super low? Didn't he just say that Bitcoin was going to run? And now he's saying that housing is a leading recessionary indicator and it's now pointing to a second half 2024 economic downturn. Well, we're basically almost in the second half of 2024. And he just said that Bitcoin's going to run to the upside. So is he saying that Bitcoin's going to run up at the same time that we're going to have a 2024 economic downturn? Is that what he is kind of saying? If so, that kind of seems contradictory. I would say Bitcoin is a indicator of liquidity in the system. And if you've got a bunch of liquidity in the system, I don't know if you're going to get your economic downturn. And I don't think that existing home sales and where inventory is located, I don't think we're in that situation personally. Now, we could get a tech slowdown, but I think that's going to hit Bitcoin. I don't like, I think it's highly possible that technology stocks and NASDAQ could slow down and Bitcoin could even roll over at some point. That I could see, but it's not going to be a slowdown from the housing market, in my opinion. At least not yet. Michael says, emerging versus developed market equities, what would need to happen for this trend to change again? I can tell you what would happen. In '02, we saw a weak dollar. We saw declining interest rates, weak dollar, and I think that's what's going to come. We're going to see weak dollar and declining interest rates, and that's what's going to boost emerging markets up. They may go down like during a certain portion of it, but for the most part, it's going to work its way on up. So that's my opinion there. Here's John. He says, loading a 400-ton haul truck in 1 minute, approximately 20,000 tons per hour, 220,000 tons per shift, 440,000 tons every 24 hours. Anything over 1% copper equivalent or better is considered to be high grade. The rest is waste, mining for copper. So they're moving all of this earth to get 1% ore grade of copper out of the earth. And here's the thing, how is AI necessarily going to better this? You're either going to move earth to do it, or you're going to inject something into the earth to kind of soak up in a chemical, perhaps copper. That's called in situ mining. They do that with uranium. They do that with oil too, to some extent. I think that's called like water flood. They do all these different types of flooding techniques and stuff like that. But I don't think it's been used in copper, but maybe they could figure something out, AI or something like that, some chemical to kind of leach it out of the ground. Not too sure there, but that's how much earth they have to move. And with 1%, I mean, it's not a lot of copper, guys. The 10-year 3-month curve has been inverted for 19 months, continuing at an all-time record. So this is the real estate cycle or business cycle going back and forth. That's what this is measuring. The real estate market is generally what drives it. And when the yield curve inverts, that's when you go into an expansionary phase of real estate. And that's when you get that inflation from the credit expansion. It occurred in the late 1980s, early 1990. Then we had a recession in 91 from the housing market. We had another one here, but this was the NASDAQ. It was not caused by the housing market. The housing market blew up when they lowered rates for this tech crash. It went all the way back down and inverted again, late 2000s. And then we uninverted. And that's when we had a lot of inventory and credit problems and defaults on loans, which was a pretty big recession there in '08. And now we've been kind of trucking forward here, and we're inverted again. So a lot of people are saying that this will invert, that this is a leading indicator. And what I'm going to say is, what if we stay down there for a while? Like, it's an indicator, but it's an indicator of where we're at in the cycle. It's not it's not like a recession just comes out of nowhere. So I would be looking for things like a spike in oil prices to agitate a recession, I'll call it. Look at the housing market. Look at existing homes of inventory. And if we're going up to like 8 months, then yeah, maybe we could get a slowdown from real estate. But we just don't have those signals at this exact moment. So Triangle Investor says, a lot of people saying there is a disconnect between the uranium equities to news flow. I partially agree. Why partially? Because in my opinion, the uranium producers and developers are not in any disconnect. They are going in the right way. Some of them are all-time highs. The only disconnect right now is that the explorers who always, in every commodity, perform better later in the cycle. And when they do go up, they go up sharply. He's correct. And disconnect at all. I think people are too impatient, and I think there's a problem with patience. News, they're going to write news about it. News doesn't really, it doesn't push this bull market. What pushes the bull market, in my opinion, is when people feel losses in their account in other sectors, and then they start looking to invest in other sectors. I think when technology stocks start to get hit in the head a little bit more, and uranium stocks start to move to the upside, that it's going to draw money into the sector. We could see some money flows into it. So when technology stocks stagnate or go down a little bit, people are going to get bored, and then they're going to look for something else. They're going to see uranium's going up, and then the money's going to flow in. Not all of it, but some of it. Another one with Logan, he says total balance of delinquency status, and we're just not like last, you know, market yet. We're still super early. So even if we're coming down and we're just starting, and again, this can go sideways for a while, I don't see the forced selling for a housing market crash, at least not yet. So it's going to take some time, I think. Interactive new home construction map from AEI. You can see a lot of people moving to the, I'll say, the Mountain West, some in the south, and the southeast is all the green, which is the greatest new home construction activity. Then you can see, obviously, there's some other activity going on in the orange. That's the next level. Yellow, orange is the next level of building. Red being the least amount of building, like New York. Berg says people will obsess over sports teams when they could be doing the same with sectors and companies which will directly affect their future. Obsess over things that have the ability to improve the quality of your life. And I hate to say it, but I do that. That's the exact reason I got so interested in investing, is because of the upside potential and how it could change my life. That's the entire reason I got so obsessed with it, and why I never got into sports stuff. I played a lot of sports growing up. On very competitive teams in hockey and baseball. I played some football too when I was younger, and even soccer when I was really young. But I don't see why people obsess over it when you could be researching companies, changing your future, and earning more money and learning how to invest. So RevCap says, good visual here on just how extreme the housing market has gotten. I think what gets missed because it's new this cycle is net worth, yours and your parents', is a larger determinant of home prices than income. 35% of homes are bought all cash, many paid for by the parents. That's pretty crazy here. So what must homebuyers earn to afford the typical U.S. home? And they're showing what they should be earning here on a year-over-year change and how much it's fluctuating. A lot of people, what they do is they assume that every buyer is going to get this mortgage, and they're going to borrow all this money. Not all the time. There's a lot of cash only buyers, and then there's a lot of people who put large down payments down. You don't have to put 20% down payment. You can put 80% down payment and do 20% for the loan. I mean, there's nothing here stating that you have to do X or Y. The hardest part is to get in the game. Getting in the game is the hardest part. Once you're in the game of the housing market, you've got your down payment that you've already put down, you're building equity, you can use that equity to buy other things, like another home if you were to sell your house and buy another house. You got to get in the game, though. Triangle says, which stock in your portfolio is current biggest loss and how much percent? My biggest loss is a potential complete total loss on a position, 100%. I own a company, Nornickel or Norilsk Nickel. I own that. It's a Russian company, and they took it. It's like frozen or whatever the heck it is, and that could be 100% loss potentially. So it's my position size that has kept my portfolio doing well. Cuppy says the whole hedge fund industry has become retarded. With a few exceptions, most PMs have failed to beat the S&P for multiple consecutive 3-year rolling windows. Sure, PMs can say they've volatility adjusted the return stream, but at some point, LPs ask for absolute returns, not volatility adjusted ones. Project Zimbabwe is starting to intensify, and LPs will increasingly demand upside exposure. The old model is dead. Getting paid 20% to underperform the risk-free rate of money market account is value destructive. It's good to see LPs pushing back. The industry needs to shrink so that the strongest PMs can thrive. For everyone in our industry, the motto should be alpha or death. Let the redemptions intensify. And PMs is the people who have money invested. Or LPs are the ones who have money invested. PMs are the one who are running those hedge funds. This is small banks doubling down on commercial real estate. So maybe this is a double bottom, perhaps. And maybe we'll run on higher for commercial real estate. Big question mark. I don't know. I don't know the commercial real estate. I don't know it that well, that sector. But this is the data here that small banks are doubling down on commercial real estate. It says, I love this so much, and this is your net worth. So people who do not have a lot of money and people who do have a lot of money are buying cheaper commuter cars like Toyota. And then the people in the middle who think they're rich, kind of the 50th percentile and slightly above and below, they're buying the ones like Porsche, BMW, Jaguar, and Lamborghini. So they're the ones spending all the money. The ultra rich, at least according to this, is buying Toyotas and Hondas and stuff. I drive a Honda for whatever, and Mazdas. Trond says, just a commentary regarding miners who often have diluted shares in order to finance mines, etc. Be very careful when calculating upside targets or doing other technical analysis over a very long time span. A short time span is okay, for instance. And what he's doing is we've got CDE going down, and this is CDE and their market cap. I don't like using market cap because market cap tells you absolutely nothing about the value of the company, like the actual value behind it. It doesn't tell you anything about cash flows. It doesn't tell you anything about reserves. It doesn't tell you anything about what tier those reserves are at. It doesn't tell you anything. So how do I know if an oil company in '05 has a market cap of 1 billion? I'm just using an oil company, for example. And then we're up around, past 2 billion. And it's like, oh, well, this has gone up. It's in a bubble. And it's like, yeah, but what if it's increased its reserves by like 2,000%? Then this market cap is absolutely worthless. So I'm not a big fan of using market cap only. I'm a big fan of looking at what the company has in reserves and then saying and comparing what do those reserves look like in relationship to the value that that company has. And then what's the cash flow that they've got? And then price it off of cash flow, because your market cap is absolutely worthless without any sort of value tied to it, in my opinion. The narrative rates are restrictive and housing inventory is building. Here's the inventory. It's building here, guys. It's building right there. You see it on the chart? No, we've been in a big downtrend and we're at very low levels, and we could go up for like 5 or 10 years in inventory and still be in a bull market of real estate if they go up real slow. And that's where I've got it. That's where I'm going to end it, guys. So that's what I've got for today. Thumb up for the content. Subscribe to the channel. Subscribe to the website. We've got the Sunday, which is today, question and answer session coming up at 5 p.m. So that's just a reminder that it's coming. And we'll see you there if you're part of the website. All right, guys. We'll catch you later. This is Finding Value.